All right, if you joined us and you're watching this via recording, we just completed Roman numeral 1 and Roman numeral 2. Those are easy. I think you can read them and ask me any questions. Sorry, I forgot to turn it on, but we're just ready for Roman numeral 3 right here. We're going to be reviewing for contingent liabilities. So let's think first of all about what a contingent liability is. A contingent liability is as opposed to an actual liability. For example, accounts payable will be an actual liability. The reason is we definitely know the client owes that payable, and we definitely know the amount. On the other hand, a contingent liability is much more up in the air, much fuzzier. The client may not owe it in the end, and or we don't know usually what the exact amount is going to be. So that exact amount is contingent upon whatever happening as well. A great example of a contingent liability is a lawsuit. So there's a lawsuit in court. We're not sure whether the client will lose the lawsuit and owe the liability to the plaintiff, or exactly how much. Well, as you studied about in financial accounting, for a contingent liability, if the amount, if the probability of loss is probable, which usually means 90% or greater, then we must accrue that contingent liability as long as we can reasonably estimate the amount. If, on the other hand, the probability of loss is only reasonably possible, but not probable, we're only going to disclose the contingent liability. Same thing if we cannot estimate a good figure for the amount of the loss. So oftentimes clients do not record contingent liabilities as they should. They may not realize that, or it may be deliberate because they don't want to admit to more liabilities. Another thing is, again, they may not disclose everything they should about a contingent liability. So we audit them pretty carefully. And we'll see in A that that's going to partly tie into our period liability tests. I'll tell you what they are. A lot of contingent liabilities may have been found here. So let me put my little piece of paper up here again. I'm going to stop my share for a moment. And let's see, whoops, I need to move that over onto camera. All righty. So as we look here, this time between 12/31 and 2/15, as we're doing field work, we're going to do some out-of-period liability tests. It means we're going to look for additional liabilities that the client did not record. For example, if a bill comes in from a vendor who sold the client something during this period, we'll trace back to accounts payable and make sure there's a payable from that vendor as of 12/31. Well, let's say on the other hand that that lawsuit was settled up during this time, during January or the first half of February. We're going to make sure that the client changes that from that contingent liability into an actual liability. That's a subsequent event. Or I'm sorry, that would be a part of our period liability tests. It's also a subsequent event, as we'll see a little bit later. If we get more information about a contingent liability, for example, how might it be settled up in court? Or in the case of a product lawsuit, a consumer product lawsuit, are there more potential plaintiffs out there that have come forward because of this defect in the product? So again, all those reflect out-of-period liability tests. The auditor is just very aware of what's going on during this month and a half. Okay, so may have found some contingent liabilities there. Let me go back to sharing my screen. There. So may have found contingent liabilities there, but there are also some additional tests we need to perform. First of all, we need to inquire about additional contingent liabilities, and that should be documented in what's called the letter of representation. We'll see that later in the chapter. It's also known as a client representation letter or management representation letter, or just the rep letter. But in this, management must say there are no other liabilities other than what we've disclosed to the auditor. That includes contingent liabilities. So this way, if management holds something back, it's their problem, not ours. Then number 2, we'll review minutes of stockholder and board of director meetings. They discuss big ticket items, including maybe contingent liabilities. And then number 3, we're going to review dealings with legal counsel. So why client did you go with a lawyer each time? So one good procedure is to examine the client's legal expense account to determine the reason for each expense. So again, why did you go to the lawyer each time? And the auditor should also inquire about about existing and pending litigation with the client's attorney. I'll show you in a second, but this is going to request an opinion as to the probable outcome, damages, and existing and potential legal problems up to the audit report date. So let me go to the book and then I will come back and look at the rest of this with you. So going to page 772. So typical inquiry of attorney. Now, some years ago, this used to be called confirmation. Now it's called inquiry. So confirmation is a totally independent outside party. Inquiry is not. Inquiry means asking the client something, or in this case, a very biased party, the client's lawyer, who's very biased to say, sure, we'll win. Or if we're going to lose, it won't be too bad. So again, that sample company that we have all the way through, the Hillsburg Hardware Company up in Gary. So this letter, there is no standard language in it, but there are a lot of industry best practices built into what we see here. This letter's been generated by a template that PPC software has. So set up in general form and you tailor it to your client. So I think here we'll glean some good details as we take a look at it. So our auditors, Berger and Anthony CPAs, are conducting an audit of our financial statements for the year ended December 31st. In connection with their audit, we prepared and furnished to them a description and evaluation of certain contingencies, including those attached, involving matters with respect to which you've been engaged and to which you've devoted substantive attention on behalf of the company in the form of legal consultation or representation. For the purpose of your response to this letter, we believe that as to each contingency, an amount in excess of $100,000 would be material and a total of $700,000. So don't worry about the small stuff. However, determination of materiality with respect to the overall financial statements cannot be made until our auditors complete their audit. And your response should include matters that existed December 31st and during the period from that date to the completion of their audit, which is anticipated to be on or about March 15th, the Ides of March. So we went for the middle of February, and here they're looking at the middle of March. That's fine, that's when they end field work. So please provide to our auditors the following information. First, such explanation, if any, that you consider necessary to supplement the listed judgments rendered or settlements made involving the company from the beginning of this fiscal year through the date of your reply. So we've settled up some lawsuits. We have actual amounts for them. They are no longer contingent liabilities. We actually owe them and we know the actual amount. So just comment on those. Number 2, also comment on the following. That you consider necessary to supplement the listing of pending or threatened litigation, including an explanation of those matters as to which your view may differ from those stated. And an identification of any omission of any pending or threatened litigation claim, assessment, or statement. We want the list to be complete because, again, completeness is the problem. So somebody is in court right now suing us, that's pending, threatened. Well, they haven't sued yet, but they're saying they're going to, and it looks like they've got a good case. And finally, number 3, that you consider necessary to supplement the attached information concerning unnecessary claims and assessments. An unnecessary claim or assessment, a product liability lawsuit is a good example. So nobody has yet, or a number of people, I should say, have not yet sued regarding product defects, but we know they're going to. Those are unnecessary claims and assessments. They can be quite large. So that's why I wanted to show you there. Let me come back to my notes. So reading on right here. Well, attorneys are sometimes reluctant to apply because they may feel that they're going to compromise cases. However, if they refuse to comment on information which is within their purview, this constitutes a scope limitation and could cause the audit to be modified. In other words, we might even give a disclaimer opinion. The client wouldn't like that. And of course, we note this inquiry is not unbiased. The auditor may have to contact an independent attorney, in fact, to obtain a second opinion. And in this case, the client still pays for it. So that thing about the lawyer not responding. Well, if they don't respond, we say to the client, you're not going to get a clean opinion because of the scope limitation. The client's going to go back to the lawyer and finally get an answer because the client knows there are all kinds of other lawyers out there, and so is the lawyer. In fact, I think you'd much rather be an accountant than a lawyer. A lot of lawyers out there, and I've had a lot of people with JDs and LLMs that have come back to do accounting. So now accounting can be combined very well with the JD or LLM, but a JD or LLM by itself is not a ticket to success. It used to be, not anymore. Too many of them again. Now, something else we'll do as an auditor with reviewing for contingent liabilities. We're going to review the provision for income taxes and any revenue agent reports. The IRS is trying to get money out of the client, contingent liability. Then number 3, review lines and letters of credit and confirm them. A line or a letter of credit, just like a home equity loan, if there's a line of credit for that you can write on, same thing here. Possible contingent liability. Then review commitments, such as for purchases, pension plans, profit sharing plans, warranties. So for purchases, if we have a purchase contract with the vendor, we may have to buy a certain minimum amount by a certain date. If we do, that's good. If not, we probably owe a penalty clause. And that penalty clause is a good example of a contingent liability. Pension plans, which you study in financial accounting, well, there is, in that case, a contingent liability that you record. Contingent upon the person vesting, contingent upon their lifespan. Same thing with the profit sharing plan. Warranties, contingent upon the product breaking down. So if we sold a unit this year with a warranty, we've got to estimate future warranty expense for the rest of the warranty life. There's contingent liability, again, contingent upon that product needing to be fixed. Then 7, we'll review transactions after fiscal year end, and that overlaps without period liability tests. And number 8 is just being aware of news items which affect clients. And most auditors maintain a clipping file of news items. They gather that throughout the year. And that task is now a lot easier because of online databases than it used to be in years past. So, for example, if we were Johnson & Johnson's auditor, we would have plenty to do right now related to their vaccine. And there are certainly a lot of unnecessary claims and assessments there with blood clots. So let me come back here and stop my share. Any questions or anything? All right. The next thing we're going to do is the review for subsequent events. So we're going to be right in this time frame here. Let me go ahead and write that down. So during field work, we're going to review for subsequent events. Again, something that happens after fiscal year end, but before the audit report date. And we'll see how that can affect the financial statements. So we may have to make sure it's included in financials. I'll show you that as we go through the next section. So as I come back to sharing my screen, numeral 4, about reviewing for subsequent events. So again, those are events which occur between fiscal year end and the audit report date, and they materially affect the financials in some way. And since the audit report date is given, or rather the audit report is given on the audit report date, the auditor must be able to assert that the financial statements are fairly stated based on all information he or she could have known at that date. And that implies the auditor has to actively search for subsequent events up through the audit report date. For example, a good example of a subsequent event would be where the client buys another company during that time, or spins a subsidiary off, or if there's a big lawsuit that just popped up, or if there's a big uncollectible account receivable where we just now decided that it truly is uncollectible and needs to be written off. So in B, a subsequent event may require one of two things. May require an adjustment, which means a change of dollar amounts to the financials. That is if it relates to a condition which existed at fiscal year end and therefore provides more information about the financials. So with that account receivable, let's assume that it did exist as of 12/31/21. So it was for a 2021 sale. It was to be collected in the early part of 2022. However, in the early part of 2022, that client declared bankruptcy, like a lot of retailers. Well, too bad. The client will not get their money. We must make sure that the financials are adjusted so that that account receivable is written off. So even though this client bankruptcy occurred, let's say during January, we've got to go back to the previous year's financials and make sure that account is written off. Now, the second thing it may require is disclosure but no adjustment. Well, it may relate to a condition which existed fiscal year end but requires no adjustment, but we're simply going to have more information about it. For example, more information about contingent liability. And on the other hand, it may relate to a condition which developed after fiscal year end. For example, that big receivable that was written off. Let's say the sale was not in 2021. In fact, no receivable from this customer existed at that time. On the other hand, the big sale was made during January of 2021. Then the customer turned around and declared bankruptcy at the beginning of February. Well, we have nothing to adjust in the 2021 financials. We will in the 2022 financials, but at least in the 2021 financials, we will have a footnote to warn everybody that this happened. And by the way, a lot of people and a lot of customers, right before they declare bankruptcy, go on a shopping spree. They want to write as much off as they can, default on as much debt as possible, and of course, keep the merchandise. Now, in C, I'm going to talk about what happens after the audit report date if something pops up. So let me stop my share for a moment and write something down on my piece of paper. So it's going to take some time to issue the financial statements and the audit report. So let's say that even though the audit report day is dated 2/15, this client drags their feet and 1 month goes by before they finally issue the financial statements and the audit report. So they get everything printed up. If they still issue paper copies, get everything posted online, get Form 10K filed with the SEC, etc. So in that case, we're going to have a time break right in here. Well, we might just have something big that happens. So big that we have to say stop press and let's include it in the financial statements. That's what I'd like to talk about next. So with that, just make sure I'm jibing with, yes. So with that, let's say that we find something, again, big during this time. What we will do, we will say stop press and we will treat it just like a subsequent event. So let's see how this works. Again, something big, not something run-of-the-mill. Let me come back to sharing my screen. So in C, if a major event is discovered after the audit report date, but before the report is issued, so just like that 1 month time frame that I showed you there, the auditor should treat it as a subsequent event. And the auditor has two options in dating the report. First of all, he or she may only audit the subsequent event and dual date the report. So in this case, the report would be dated February 15th, except for footnote 10, which is dated March 15th. That's the most common thing to do. But the other option is to extend the search for subsequent events to this later date and single date the report. We'll never know how often that's done because that single date doesn't clue us in that there's even been some additional event. That I know that that's not as common to do in the profession because the client has to pay more. The auditor's going to review for all subsequent events, and that's why. Now in D, audit procedures which can uncover subsequent events include inquiry. Again, management must let us know, otherwise they're negligent. Review and dealings with legal counsel, that's a good way. Examining minutes of stockholder and board of director meetings, again, they talk about big stuff. We can review any interim financials after fiscal year end and interim financials for less than a year, like a quarter, if the client issues them. We can review transactions after fiscal year end, so looking for subsequent events there, and obtaining the letter of representation from management, which we'll see in a little bit. Again, management is responsible for making sure everything's been disclosed to the auditor. If they don't, then they have a credibility problem. We may not wish to audit them again. Now, in E, let me pause my share for a moment and show you something there. Hang on a minute. So the next thing is, what happens on out here? What about after the financial statement issuance and the audit report issuance? Well, some things could still happen. And if we find something that would impact the financial statements, again, we might have to go back retroactively. So we'll see this is called subsequent discovery of fact. And it's going to be something big and something bad that the auditor missed. Okay, so everybody got the time frame? after March 15th. Okay. Let me share my screen again. And it's in E. So we can note the subsequent events were events which were uncovered before the financials were released. But if a similar event is uncovered after the financials are released, it's termed subsequent discovery of fact and indicates that the financial statements were either misstated or lacked adequate disclosure. So again, it's a bad thing and it's something big. By the way, the most common thing is fraud. The audit went okay, clean opinion. Later on, fraud came to light. Whoops, these financial statements were misstated. They were cooked. So needless to say, the auditor gets very nervous. So reading on, notice therefore about a condition which existed before fiscal year end. In this case, fraud did exist then. And the auditor is going to take action if it can be construed that he or she should have known about that fact at the audit report date, or financial statement issuance if it's a really big fact. So here's the best solution. Recall the financials, correct them, reissue them. That's what happens in fraud cases. The client needs to clean up, probably get a new management team in. The auditor does another audit. Now, hopefully everything's okay. Can issue a clean opinion to this client who's been fixed. With doing that, excuse me, if the client is a public one, and they usually will be here, they also need to file a new Form 10-K with the SEC. The new Form 10-K is called a 10-KR, R for revised. Then number 2, the client should inform regulatory agencies and stockholders. Now, if the client refuses, then the auditor should inform the board of directors. And if the board of directors still refuses, the auditor must inform regulatory agencies like the SEC, the PCOB. This is one of the few occasions where we can be a whistleblower. Otherwise, we have to keep our mouths shut, unfortunately. And subsequent discovery of fact differs from subsequent events in the no active search is required. But the SASs say this. However, if the auditor becomes aware of it, he or she must act accordingly. So take action and make sure those financials are corrected. Any questions there so far? All right, the next thing we do is final evidence accumulation, wrapping up loose ends. We will do a final round of analytical procedures just to make sure things are still on target because it's been a little while since we've done them. One reason we do them is in B, to evaluate the client's going concern assumption. Again, I say again because we should have evaluated that at the start of the audit. But our task is going to be to make sure that we feel the client will continue in business for 1 year after fiscal year end. That's our task. And unfortunately, a lot of brick and mortar retailers have gotten audit reports which said there's a going concern problem. So analytical procedures help here. If we see they're declining, like the current ratio is below 1.0, this client has problems. Again, are we a going concern for 1 year after fiscal year end? If not, we would warn the stockholders in the audit report. And we saw that way back in Chapter 3. Just wanted to make sure that you knew that it can come up. Then in C, we'll obtain that letter of representation I've kept talking about. We get it from management. So management writes it to the auditor. It's dated as of the audit report date, and it's designed to document responses from the client, as well as to impress upon the client the responsibility for the assertions in the financials. It also helps to delineate management's responsibilities opposed to the auditor's responsibilities. I'll show you a list of items to include in the book in the second. And Well, note the rep letter is not objective, thus must be corroborated by more reliable evidence. But the auditor is faced with a potential scope limitation if management does not provide full disclosure in that rep letter. So without further ado, let me come to page 778 in the book. So here we are again at the end of the audit, and we say, management, you're responsible for the financial statements. Here are some items you've got to comment on to us. You need to do so in the rep letter, which comes to us from you, and it is required. So tell us about your financial statements. So acknowledge that you're responsible for the fair presentation of them. So state that in writing. We know that management is. We just need to confirm that with you, that you understand. Then management's belief that the financial statements are presented fairly in conformity with applicable accounting standards like Gaap, pardon me. So management say, yes, we believe the financial statements are fairly stated. After all, they are yours, you're responsible for it. Then completeness of information. So management did not withhold anything. So availability of all financial records and related data, management did not hide something from us. Then completeness and availability of all minutes and meetings of stockholders, directors, committees of directors. So we have each set of minutes or a summary of the discussion. All those sets are complete. Nothing was left off. Everything was made available to us. And then absence of unrecorded transactions. So nothing was left off. Once again, everything is complete. If management knows there's an unrecorded transaction and did not tell us, now they're in trouble. Then we also need comments about recognition, measuring, disclosure. So management's belief that the effects of any uncorrected financial statement misstatements are immaterial to the financial statements. And we'll have a summary of those. I will show you a summary of those in the next section. Also, tell us about fraud. So any information involving fraud that involves management or employees who have significant roles in internal control or others where there could have been a material effect on the financials. So the big frauds, let us know if you know. It's like if you know something, say something. The next, information concerning related party transactions and amounts receivable from or payable to related parties. Make sure all that is disclosed. Related party transactions are high risk, so we need to know about them. Then, we also need to know about those unnecessary claims or assessments that the entity's lawyer has advised are probable of assertion and must be disclosed in accordance with the accounting standards. Again, think about poor Johnson & Johnson with his COVID shot. Then finally, subsequent events. Tell us about those. Like a bankruptcy of a major customer with an outstanding account receivable balance as of the balance sheet date. It's going to have to be written off the next year. And then a merger or acquisition after the balance sheet date. Merge with another company or acquire another. So we need to know all about those things. So management, please document those in the rep letter. Any questions about those? Right. Then another thing we'll do indeed. We'll read the other information in the client's annual report to make sure it's consistent with the financials. For example, management's discussion and analysis of the financial statements, so-called MD&A, which can take up pages and pages and pages in an annual report. If there's anything that the client mentions in management's discussion and analysis or this MD&A section, well, we need to make sure that that ties back to the financial statements and agrees with the financials. Sometimes it doesn't. Sometimes clients make errors here. So we don't like an annual report going out where the discussion is different than the financials. Looks bad. Then the next section, overall audit results evaluation. So are these financials fairly stated in accordance with Gaap or not? And it's normally done by the partner in charge of the engagement. One thing that partner is going to ask, is the evidence sufficient? Do we have enough? And there's often a checklist, just glance out when you have a chance to look. It's a very shortened one from what's used in practice. But this way we make sure that we don't miss any evidence. Then B, there should be a final working paper review. And that's where the senior reviews the junior's work, gives the junior some review notes to clear up. Then once the junior does, the senior approves the working paper. But now this partner in charge should do a final working paper review. So again, they were normally reviewed at each level of the audit team during field work. Should now be a final review at the partnership level. Then in C, we'll form the audit opinion. Are the client's financial statements fairly stated in accordance with Gaap or not? And we'll make sure the evidence agrees with that. And we'll note that a part of this involves determining whether the sum of the past or immaterial audit adjustments material. By the way, when I first started out in auditing, I thought that that was supposed to be P-A-S-T, not P-A-S-S-E-D. So these audit adjustments that are immaterial, we passed up taking action on them individually when we saw them. We said, oh, the client doesn't need to correct that. We can still give them a clean opinion. But we still keep track because the grand total might just be material, all the adjustments we find. So past audit adjustments should be entered on a worksheet I will show you. And both the auditor and management must agree the past audit adjustments are immaterial, both individually and in the aggregate or in total. And for all adjustments, by the way, which were individually material, the trial balance should still be adjusted when discovered. However, you still notify clients of past audit adjustments so they can make them after the audit's complete. And that helps prevent these relatively small errors from compounding in the future. And there might also be a financial statement disclosure checklist. I'm not too worried about that. What I'm more worried about is on page 783, again, the past audit adjustments. Come to that in the book. So unadjusted misstatement audit schedule, same thing. We see it comes from audit software, specifically PPC, although they don't say that. It's Windows-based, we can tell, by the taskbar up top. So again, pertaining to the Pillsbury Hardware Company, let's see what they had. They had 5 past audit adjustments, relatively immaterial. So understated allowance for uncollectible accounts, accounts receivable sales call-off misstatements, difference between physical inventory and book values, unrecorded liabilities, and repair expense items that should have been capitalized. So there are the total amounts and how they affect the balance sheet and income statement, income before tax. And as it turns out, individually, those were immaterial. But we keep track of the grand totals just in case they are material, and they've said they're not here. Oops. So let's look at this auditor's conclusions. Well, the net effect of the above items are as follows. So in current assets, $185,000. We see that number comes from right there. Total assets, 360. Have to add them up. And income before tax is 75. Materiality, tolerable misstatements in this case, right there. All of these possible audit adjustments are well below those materiality thresholds. So as a result, we say they're immaterial individually, and the grand total is also immaterial. Let's see that in writing over here from Leslie Franklin, who's obviously the junior on the engagement. And Leslie Franklin made this comment on 315. So it says that none of the aggregate effects or the individual items has a material effect on the financial statements in total or with respect to the components they pertain to. Leslie should have gotten a review note, don't end that sentence in a preposition. So should be to which they pertain. On this basis, adjustment of any or all the items is passed. So we're not worried about these. We can still issue a clean opinion. However, we still pass these along to the client. This way, the client can make these adjustments later. We hope they do. We hope they look for similar adjustments, and for whatever's going on underneath, we hope they correct that problem. For example, if we have someone on staff who does not know how to capitalize repair items, because the same company that does repairs that are expensed can also do capital repairs for you. An example of one that would be expensed would be new tires on a vehicle. One that would be capitalized would be an engine overhaul. But the same vendor may do both. So that's one reason why they sometimes get mixed up. Again, we need to train our employees better. Hopefully they won't do this next year. And next year, this thing could spiral, get bigger and become material. So we'll nip it in the bud. Then, ND, a concurring partner review. And that's a review by an independent partner, generally one with quite a bit of experience, to make sure everything's in order. So another partner, shall we say, audits the audit before it goes out. Then we'll communicate everything in the way of audit results with senior management and the board of directors or other similar group which is charged with governance. For example, our auditors from Clifton Larson Allen always come to us and review what's going on, and here are the findings that we had. So the auditor normally writes an exit memo and conducts an exit conference with the client at this time. So some things the auditor must communicate. Any illegal acts or fraud they found, or any significant deficiencies and material weaknesses with internal control. They must tell us. We saw that under internal control a while back. And there are some other items to report under the SASs, as well as under the Sarbanes-Oxley Act. Let me look at those on page 786 with you for a moment. So the other communications here with the audit committee. Again, I get to hear this at 4 to 7 because I'm on the audit committee here. So one thing is to communicate auditor responsibilities and the audit of the financials. So the communications should include discussion by the auditor that the audit of the financials is designed to obtain reasonable rather than absolute assurance about material misstatements in the financial statements. That sounds really familiar. And for audits of financial statements, do not include an audit of internal control or financial reporting. In other words, no 404 report. So we're dealing with a privately held client. The communication also indicates the auditor is not providing an opinion on the effectiveness of internal control. Then number 2, to provide an overview of the scope and timing of the audit. So that's to provide a high-level overview, such as the auditor's approach to addressing significant risks and consideration of internal control and the timing of the audit. And details the nature and timing of audit procedures not appropriate to avoid compromising the effectiveness and predictability of the audit. For example, our auditors here at Florida Southern tell us that they pull at least 100 individual student financial aid records. They perform walkthroughs of them, making sure that internal control is followed each step of the way. That's a high-level overview. They do not tell us the specific students they're going to pull or the specific tests that they're going to do in their walkthrough. Because if they did, they know financial aid is going to go in and clean those records up. So we want more of an element of surprise. Then, number 3, to provide those charged with governance with significant findings arising during the audit. So here are the big things we found. And these communications include discussion of material misstatements detected during the audit that were corrected by the client, and also uncorrected misstatements that were accumulated by the auditor. And the auditor's view of qualitative aspects of significant accounting policies and estimates should be presented, as well as significant difficulties encountered during the audit, including disagreements with management, among others. By the way, disagreements with management must be footnoted, and clients want nothing and usually have nothing in that footnote. Then to obtain from those charged with governance information relevant to the audit. So the audit committee or others charged with governance, such as full board of directors, may share strategic decisions that affect the nature and timing of the auditor's procedures. And also, like I've said before, our auditors go around the table and they ask us if we know anything they should know. And that would, of course, include fraud. I've never known anything they should know, so neither has anyone else. So they run a pretty good ship at Florida Southern, if I do say so myself. Any questions about these? All right, let's come back to the handout. Now, something called the management letter. It's optional for the auditor to write, but it's a very good business practice. And the purpose is to help the client improve the efficiency and effectiveness of its operations. It does not address the standard audit results. It differs from the letter of representation. So the letter of representation was required. It came from management to the auditor. The management letter is optional. It goes from the auditor to management. So the auditor just says, here are some good suggestions for improvement. And that's nice because it helps the client feel that they got some value out of the audit. That takes care of Chapter 24. And any questions before we go on to the material I'd like to cover from Chapter 25? Anything there? All right, Chapter 25, I won't cover the whole chapter, except I will cover some additional topics in that bonus video that I said I would post after the class is over. Just watch it for purposes of the CPA exam. I won't test you on the material. So let me share my screen again. And as I do, I'm going to look here at the handout, and I emailed this to you, although it's under Canvas, under Files. And the handout here is for special reports. The material here comes from 5 different auditing sections. AU-C, AU standing for auditing, C, clarified. A few years ago, they tried to rewrite the standards to make them more clear to readers. I don't know if they succeeded or not. So a few topics here that I'd like to cover. So special reports, not really a standard audit report, but based on it. So why might we do these things? Well, one reason we might is for financial statements that were prepared in conformity with a comprehensive basis of accounting other than GAAP, something like the cash basis, as we'll see. And such comprehensive basis is termed a special purpose framework. And the following are special purpose frameworks, and therefore they differ from GAAP. One thing is compliance with regulatory requirements. For example, in some states, public utilities have to depart from GAAP in some ways. A common reason why is because they need to have current fair values for certain assets, not historical costs as GAAP would want. The income tax basis, very common. It would be for a privately held client and usually a small one. Why are they having financial statements? Because of taxes. And we can do an audit and discover whether those financial statements are in accordance with the income tax basis. Or number 3, cash basis or modified cash basis. Again, usually a small client. Cash basis means revenue is how much cash goes in, expenses, how much cash goes out. The difference is profit. Makes perfect sense to a small business. And then number 4, a definite set of criteria having substantial support, such as price level basis accounting or IFRS. And we can do an audit under each of these. We'll just change the report slightly. In fact, we've already seen this report. It's called a Rule 203 report, and it's permitted under Rule 203 of the AICPA Code of Professional Conduct. So in fact, way back in Chapter 3. So let's see what that report contains. There is an example of the report in the text. Usually it's better, I feel, if I just tell you what the differences are, tell you the highlights. So when reporting on special purpose framework statements, some differences from the audit report on Gaap statements. First of all, the basis of the presentation must be stated. So is it the cash basis? Is it the income tax basis, etc.? And then the auditor expresses, or sometimes has to disclaim, an opinion on whether the statements are presented fairly in accordance with that basis. And then an explanatory paragraph regarding the basis appears below the opinion paragraph, so after it. It refers to the client's footnote disclosure about the basis. So usually it's short. It would discuss the cash basis briefly. And distribution should be restricted if the statements are prepared in accordance with the requirements of governmental regulatory agency, like one which is regulating construction companies and are intended solely for the agency. When you think about it, that seems strange, since a lot of reports will become a matter of public record through state sunshine laws, or in some states called public record laws. And way back, SAS 77 came to the rescue and now allows the following sentence to be added to the report. However, this report is a matter of public record. Its distribution is not limited. So just want to bring that up. Then C, the titles of the special purpose framework statements should not lead to confusion with Gaap statements, and it should include the basis of accounting used. For example, statement of assets and liabilities arising from cash transactions instead of balance sheet. So we want cash in there. And the auditor applies essentially the same criteria to Gaap and special purpose framework statements to evaluate the adequacy of disclosure, except there's just one additional framework, just one additional footnote required with special purpose framework statements. And that footnote, again, talks about what that special purpose framework is, like the cash basis. And finally, this audit is conducted under GAS. We just don't say that we're determining whether financial statements are fairly stated in accordance with Gaap. We just slip in special purpose framework instead. Any questions there? All right. Now, Roman numeral 2 is the audit of specified elements, accounts, or items of a financial statement. So we're not going to audit the full financial statement, but we're going to audit a subset instead in this type of engagement. This is very common, for example, in factoring, which means the client sells accounts receivable to some financial intermediary, like a bank, and that's called a factor. So we're factoring accounts receivable. That factor may want to have an audit of only cash inflows, accounts receivable, and bad debts expense, let's say. So an audit of the financials. So this applies to audits conducted in accordance with GAS. We'll also use something called agreed upon procedures in the next class. Don't worry about those. Just want to include that at this juncture in case you ever come back and look at this handout after studying auditing 2. And the only GAS which may not apply is the first standard of report. And that happens when the element account or item does not appear to conform to Gaap. So if it conforms to cash basis instead, we would slide that in instead of Gaap. This type of engagement may be undertaken separately, it frequently is, or sometimes in conjunction with the audit of the full-blown financial statements. However, materiality must be related to each individual element, account, or item, and not to the financial statements taken as a whole. So that's why this type of audit of the subset of the financials may be done, because suddenly materiality magnifies small misstatements, and small misstatements become material. We really, really, really get the bugs out which is probably we'll have to factor once. So here's what should be in the audit report. We'll identify what was audited, these accounts. And if the audit were in conjunction with the audit of financials, we would so state, we would describe any or indicate any departures included in the audit report. Then we'll describe the basis on which the specified elements, counts, or items are presented. Is it GAAP? Is it the cash basis, etc.? We'll give an opinion or maybe a disclaimer of an opinion as to whether the specified elements, counts, or items are fairly stated in accordance with that basis. And then restricted distribution. That means not for the general public, just for the client and any other relevant parties, if not in accordance with GAAP or a special purpose framework. That's pretty rare. Any questions there? All right, the next one is about compliance with aspects of contractual agreements or regulatory requirements related to audited financials. Well, really good examples, debt covenants of regulated industries. For example, in that bond indenture, we find all kinds of debt covenants here, like a bond sinking fund of a minimum amount, or collateral that's been pledged. In this case, the client wants to know, or some other relevant party wants to know, did the client meet all the contractual requirements, all the debt covenants in this case? Well, the auditor may accept this engagement only in conjunction with financial statement audit. So we must have done the full-blown financial statement audit. This report about compliance, which is separate, is just a spin-off of the audit. It's a supplement to it. Now, we can't give positive assurance. We cannot say, in our opinion, we believe the client complied. Can't give it that strong. Instead, we can only give something called negative assurance in C. So the auditor may only give negative assurance with respect to compliance, either as a separate report or as an additional paragraph to the audit report. So negative assurance, sometimes called limited assurance, says this: we found nothing to indicate something is wrong. So in this case, we found nothing to indicate the client did not comply. That's a lot less far-reaching than positive assurance, a lot less than an opinion. Now, the auditor may not give any assurance, though, if he or she disclaimed an opinion on the financials or rendered an adverse opinion. Those two things are so bad for highly or pervasively material items that we're going to say, no, we can't go on and talk about compliance. Now, if a separate report is issued, the auditor must include the following. We're going to state the financials were audited. We'll describe any departures in the regular audit report. Hopefully there are none. We'll reference a contractual agreement like the bond indenture or the regulatory requirements, and we'll give negative assurance regarding compliance. We found nothing to indicate the client is not in compliance. So that softens our stance a bit. We're not too exact. And to be even less exact, we'll state the audit was not directed primarily at obtaining knowledge about compliance. Then we'll describe any significant interpretations of the agreement made by management, if any, and restrict distribution of the report. And by the way, in E, if the report is combined with the regular audit report, same items have to be included. Any questions there? Whoops. Now, in the next section, we have special purpose financial presentations to comply with contractual agreements or regulatory requirements. A really good example is when the client goes to a bank for a loan. The bank says fill out the loan application. We don't want your financial statements in any form, but fill in the blanks. So the auditor may be asked to check it over. It's not a regular audit, but just taking a look at things. So these presentations do not constitute ordinary financials, and they're restricted to the parties, the engagement. And the auditor may be asked to report on these. And the presentations may or may not be in accordance with GAAP or special purpose frameworks, because the bank, for example, may want fair values of a lot of assets. instead of historical costs. Now, if the presentations purport to be in accordance with Gaap or a special purpose framework, they should differ from regular financials only to the extent necessary to meet special requirements, like those fair values the bank wants. Similar disclosures are appropriate. And the presentation should be titled so as to avoid confusion with regular financials. So don't call these things balance sheet, income statement, etc. And the auditor's report, So the auditor's report on the presentation states whether presentations are in conformity with Gaap or special purpose framework. It's going to restrict distribution. Well, if the presentation is in accordance with some basis other than the Gaap or special purpose framework, that's rare. The auditor's report must identify that some other basis and describe whether the presentations are in conformity. Well, then the last section here, circumstances requiring explanatory language in the auditor's special report. This applies to any of the preceding sections. So the following need explanation, such as lack of consistency in accounting principles. That's when the client changed accounting principles such as LIFO to FIFO for inventory, or straight line depreciation to units of production depreciation. Then into going concerns, where we're told only if the auditor's subsequent data about it is relevant to the presentation. Well, you can assume it will be. Auditors play it safe. Then number 2, if other auditors' reports are used as a basis, that's rare. Or if there are comparative statements or comparative elements, counts, or items, if prior opinions were different from the current opinion. The general rule of thumb follows. Make sure everything is laid out on the line. Go through everything exhaustively. And if you do that as an auditor, you play it safe and you'll be okay. So let me go ahead, or actually let me say that right after that, we're going to have another little section on a special report. Well, let me stop at that juncture and see, there, I see Kitty. Yeah, right there watching over you. Good, Leona. And so any questions, any comments, anything like that? All righty. So let's go here to the next one. Reports on the application of accounting principles. Comes from AUC section 915. This one is a little bit of a strange one. It's sometimes called the shopping around SAS. And the reason it is because some people go around and if they hear that you're an accountant, they're going to be asking you questions, most likely tax questions, but maybe some auditing questions too. So this section says what we can and cannot say in regard to auditing questions. You might see one multiple choice question on the CPA exam about this, and that's probably it. So applicability, what it applies to? Well, reports on the application of accounting principles to specified transactions, either completed or proposed, called specific transactions. For example, what would this transaction look like if I use the cash basis instead of the accrual accounting basis? Accrual accounting is GAAP. Or second, reports on the type of opinion which may be rendered on a specific entity's financials. So here's my whole business. If you were auditing me, would you give me a clean opinion or not? And number 3, reports on the application of accounting principles to hypothetical transactions for a specific entity. Something that's very, very up in the air, not a specific transaction. By the way, in B, this also applies to oral advice on these items. It may be used as an important input to a decision by a user. So we need to watch what we say. And it does not apply to expert testimony or testifying in court, or advice given to another accountant, or position papers. For example, if I were to write an article for the Florida CPA today, and I said, this is my position on a certain topic, I believe such and such, doesn't apply to that. Well, then performance the engagement, we're supposed to exercise due professional care, adequate technical training and proficiency, and adequate planning and supervision. But usually these don't even require much in the way of those. And the accountant must understand the nature of the request for the report. Usually somebody's trying to get free advice. And it must also understand the form and substance of the transaction. And then some items we must include in the report. So a brief description of the nature of the engagement, a statement that was performed in accordance with the AICPA standards. We don't say GAS, we're not doing an audit. And then a description of the transaction, a statement of the relevant facts, circumstances, and assumptions, a statement about the source of the information. It was someone at a cocktail party, for example. And principles to specific transactions should be identified. And hypothetical transactions should be described as involving non-specific principles. In C, we need a statement describing the appropriate accounting principles to be applied, or the type of opinion that may be rendered on the entity's financials, and appropriate description of the reason for the accountant's conclusions. In D, a statement, the responsibility for the proper accounting treatment rests with the preparers of the financials, who should consult with their advisory, normally regular continuing accountants. So go back to the accountant you're paying, get advice there, don't get free advice from me. And any, a statement that any difference in the facts, circumstances, or assumptions presented may change that report. Any questions there on that short, simple one? I know it's kind of a weird one. By the way, there's a handout case here, and you don't need to do that. All right, that takes care of section 915. If I come back here on the screen, again, any questions? Oh, Leo, you're peeking around Kitty there. Kitty wants the spotlight as usual. There we go. Now we see Kitty's face. Okay, cute. All right, next thing I'd like to do is to go to the textbook, and we're going to take a look at homework that we've got. And the homework is going to come from 2 chapters. It's going to come from number 12 and number 13. So let me go to chapter 12, homework starting on page 392. Now, I have review questions here, and I usually don't go over review questions unless one is more inclusive or it has some material that I feel we should take a look at. So let me share my screen. We see the book here for chapter 12. Again, page 392, review question 2. This one illustrates a good point. We have Jean Mayer, CPA, believes that it's appropriate to obtain an understanding of internal control about halfway through the audit, after she's familiar with the client's operations and the way the system actually works. She's found that through experience that filling out internal control questionnaires and flowcharts early in the engagement is not beneficial because the system rarely functions the way it's supposed to. So she's saying almost always there are operational deficiencies. People don't carry out internal controls that's on the books. She's skeptical. Later in the engagement, the auditor can prepare flowcharts and questionnaires with relative ease because the knowledge already obtained on the audit and evaluate her approach. Well, she's waiting an awfully long time. If she had done procedures to obtain an understanding of internal control upfront, she could have had a preliminary assessment of control risk, and she could have seen whether she really needed to conduct test controls or not. For some reason, she's waiting and she's doing things the hard way. I can assure you she's doing more work than necessary, and she's not effective. She's not efficient either. Questions on that one? All right. Coming on over to multiple choice on page 393. In number 16, dealing with deficiencies in internal control. Well, first of all, which of the following is an operational, you should have an AL there, deficiency in internal control? And the one that it is number 3. Clerks who conduct monthly reconciliation of intercompany accounts do not understand the nature of misstatements that could occur in those accounts. So that's a flaw in the operation of internal control. The others are flaws or deficiencies in the design of internal control. The way it looks on the books is not good. Then B, a material weakness in internal control represents a control deficiency that, number 2, results in a reasonable possibility that internal control will not prevent or detect material financial statement misstatements. Then C, an auditor of a large public company identifies a material weakness in internal control. The auditor should, number 4, must issue an adverse opinion on internal control over financial reporting because something is majorly wrong. Then 17, dealing with assessing control risk in a financial statement audit. In A, the auditor's test of controls revealed that required approvals of cash disbursements were absent for a large number of sample transactions examined. Which of the following is the least likely to be the appropriate audit response? That would be number 2. The auditor will increase plan detection risk. In fact, the auditor would face a decrease in plan detection risk because control risk in this case will go up. That's in the numerator. So control risk is in the denominator of the audit risk model. Mathematically, that would that would decrease plan detection risk, which is the dependent variable. And number 3, that is a close call. I think I would have given you credit for it. The auditor will not select more items to audit. In fact, the auditor is going to select more items to audit. Then, in B, an auditor uses the assess control risk tool. The answer is number 4. To determine the appropriate or acceptable level of detection risk for financial statement assertions. So to determine, in this case, plan detection risk, a dependent variable again in the model. Then C, not such a good question. It's based on an old way of stating the audit risk model, but I guess one of the authors must have liked it. So to obtain audit evidence, I'll tell you what, let me just give you the answer now. It's a convoluted question. It would be number 4. You won't see that on the CPA exam today. Then 18, concerning auditing complex IT systems. This one, I probably shouldn't have assigned. What did I assign? But I take it off the syllabus. Oh God, I took it off the syllabus. Never mind. Okay. The questions here about the multiple choice questions from chapter 12. That takes care of the chapter 12 homework. Let's go over to chapter 13. Chapter 13 homework starting on page 435. And review questions here I think were pretty basic. If you have any questions about any of them, certainly let me know. So number 20, concerning types of audit tests. First, an auditor's decision to apply analytical procedures as substantive tests or perform substantive tests of transactions and account balances usually is determined by what? It's number 2, the relative effectiveness and efficiency of the tests. Then B, the auditor faces the risk that the audit will not detect material mistakes that occur in the accounting process. And to minimize this risk, the auditor relies primarily on its number one, substantive tests, because they test dollar amounts, make sure there are no material mistakes. And then C, a conceptually logical approach to the auditor's evaluation of internal control consists of the following 4 steps. So the answer here to C is going to be number 4. We'll first do Roman numeral 4. We'll consider the types of errors and fraud that could occur. So we're looking for the order of the steps. Second thing we'll do is Roman numeral 1. We'll determine the internal controls that should prevent or detect errors and fraud. Next thing, Roman numeral 3. We'll determine whether the necessary internal control procedures are prescribed or are being followed satisfactorily. And finally, Roman numeral 2. Identify control deficiencies to determine their effect on the nature, timing, or extent of auditing procedures to be applied and suggestions to be made to the client. Then, Set 21, dealing with test controls. First, to support the auditor's initial assessment of control risk below maximum. That means below 100%. The auditor performs procedures that determine that the internal controls are operating effectively. Which of the following audit procedures is the auditor performing? Well, that's going to be test controls. Number 3. B, the primary objective of performing test controls is to obtain, that's number 1, a reasonable degree of assurance that the client's internal controls are operating effectively on a consistent basis throughout the year. And C, test controls are most likely to be omitted when it's number 3. The understanding of internal control indicates that evaluating the effectiveness of control policies and procedures is likely to be inefficient. That occurs, for example, with a small client where we just say, we're not going to bother reviewing their rather rudimentary internal controls. Let's just audit around them, do a full-blown substantive audit. So deal with one bank as we know, we'll confirm all cash with that bank. They have very few accounts receivable, we'll confirm all of them, etc. Doing a full-blown substantive audit. Questions there on any of the multiple choice? We had one problem, which was number 23 on the next page. And 11 things. Let's see what we're required to do. Then we'll go back to each of them. First, we'll indicate whether each procedure is a test control, substantive test of transactions, substantive analytical procedure. We know again that's redundant, or a test of details and balances. And second, identify the type of evidence for each one. That would be something there, such as confirmation, physical examination, etc. So let me come back here. And we see that these are 11 procedures taken from an audit program. Well, first is to discuss the duties of the cash disbursements clerk with him and observe whether he has responsibility for handling cash or preparing the bank rec. So to answer requirement A, this is a test control. Requirement B, the type of evidence, actually 2. We have inquiry, which is discussion, and we have observation. By the way, we know this is a test control because no dollar amounts are involved. Then number 2. Examine the vendor's invoices and other supporting documents to determine whether large amounts of repair and maintenance account should be capitalized. That's a common classification problem. So we bought a new machine from the same company that does repair and maintenance for us. So sometimes that gets expensed. Shouldn't have been. Should have been recorded as an asset or capitalized. So since we are dealing with dollar amounts here for A, That's a substantive test of transactions. We're looking at individual transactions. And for B, the type of evidence for each procedure is documentation. Then, number 3, we'll inquire about the accounts payable supervisor's monthly review of a computer-generated exception report of receiving reports and purchase orders that have not been matched with a vendor invoice. By the way, an exception report lists what may be wrong. Things don't fit the usual mold. In this case, here's the potential problem or exception. Well, we're only reviewing and looking to make, or I should say that we're only looking for evidence of this internal verification where the supervisor has reviewed the exception report. So this is a test of control, nothing monetary in it. The type of evidence is documentation. Then number 4, put the accounts payable trial balance and compare the total with the general ledger. In this case, we are dealing with a test of detail because we're looking at the ending balance. As far as type of evidence for each procedure, we are footing here so we can see reperformance, also reperformance comparing the total with the general ledger because the two totals should always match up. Number 5, confirm accounts payable balances directly with vendors. Well, this is a test of details because we're looking at the ending balance. And they gave away the type of evidence, confirmation, asking the outside party. Number 6, will account for a sequence of checks in a cash disbursements journal to determine whether any have been omitted. Well, you may recall a while back I said that if we're accounting for a sequence of pre-numbered documents, we always fulfill 2 types of test. A test of control, because every pre-numbered document should be there, recorded once and only once. And a substantive test of transactions, because if pre-numbers are messed up, dollar amounts will be too. Then the type of evidence is going to be documentation. Number 7, examine vendor invoices to verify the ending balance in accounts payable. So in this case, we also have a test of details. Looking at the ending balance, type of evidence is going to be documentation. So we are looking at vendor invoices here. Number 8, compare the balance in payroll tax expense with previous years. The comparison takes the increase in payroll tax rates into account. So for A and B, this is an easy one. The answer are both analytical procedures. Then 9, examine the internal auditor's initials on monthly bank recs as an indication of whether they've been reviewed. So we're just looking for the initials. We're not redoing the bank rec. So this is a good example, again, of a test control. We're not looking in this case for monetary amounts, although it's easy to read that into it. And then the type of evidence would be, again, documentation, just looking for the initials. Number 10, we'll examine vendor's invoice and other documentation as part of recorded transactions in the acquisitions journal. Same thing as purchase journal. So we're looking at individual transactions again. For A, this is a substantive test of transactions. We're dealing with dollar amounts, of course. Type of evidence would be documentation. Then number 11, multiply the commission rate by total sales and compare the result with commission expense. That's for our salespeople. So this would be an analytical procedure. Almost fell for it, although said subsequent analytical procedure, because it is an overview. And the type of evidence, again, the answer is easy, analytical procedures. Any questions here on that? All right, as far as homework goes on chapter 24, there's not much. Review questions and multiple choice questions. Chapter 25, only multiple choice. So I will make sure that you have the answers to those. you can easily review. So I'm going to have a chance, of course, to do homework on those 2 chapters. Any questions?
So the only thing for chapter 25, since you said it wasn't like the questions at the end of the notes, it's just what's on My Accounting Lab?
Exactly. And that reflects what's on the syllabus.
Okay.
It'll be short, sweet, and simple. Other questions? Anything about the exam? So it's actually going to open a day earlier. Instead of the 3rd, it'll open the 2nd. And so you'll have plenty of time in which to complete it. Just do so in one setting. Open book, open notes, no other resources. Don't ask people to help you. That's up on My Accounting Lab. Also in that breakdown, I sent you the essay questions, so please make sure that you answer those and post them to Canvas for me.
Do we have class next week?
Let's go ahead, sorry.
Sorry, do we have class next week too?
Class next week. And class next week is actually, whoa, why was I thinking that the exam was next week? All right. So I'll tell you what, for class next week, I'll do that bonus video. How about that? That's going to include some of these other topics like the meaning of Gaap, letters for underwriters, SEC filings, etc. I'm going to summarize those quite a bit. How about that? Sound good?
Is the essay portion of the test also due the 7th, or when's that one due?
The essay, do it at the same time. I think the 7th.
Okay. Okay.
Can you talk a little bit about what your expectation is for the third essay question?
Certainly. For the 3rd essay question, I don't have that file in front of me. Can you just remind me of the question, please?
It says write an appropriate unmodified, unqualified audit report for financial statements prepared under the cash basis. Also write appropriate titles for those financial statements.
Yes. So go ahead and write the audit report, because that way we're going to see how cash basis statements differ from regular GAAP-based statements. And part of that includes how the financial statement titles are going to differ. For example, instead of balance sheet, statement of assets and liabilities arising from cash transactions. Does that make sense?
I'm sorry, I'm hearing a weird noise also at the same time.
Okay.
Me too. I'm having a very hard time hearing.
Yeah.
Okay,
Hang on a second, please. It's my computer fan. It'll stop in a minute. Hang on. Still have a little bit of it. Does it sound bad? It's about to quit. Okay. Almost. Sorry about that. Technical issues. And did that answer your question?
Yes, thank you.
Okay, my pleasure. Sorry about that. What other questions or comments, etc., do you have?
Online, it says that there's a special reports homework for chapter 25 that's going to be due May 5th.
Yes. It's only multiple choice.
It's only what?
It will only be multiple choice. Just do the ones in the syllabus.
Right, but there's not one in my accounting lab.
Oh, now I know why. It's because I did not add on there because it was toward the end of class. So we front loaded the class very effectively. So that's why we don't have too much worry about it.
Okay, and then there isn't a place to upload the essay portion of the third exam.
There is not a,
There is not currently.
okay. There should be, and I'm going to go back and check it.
Okay.
Other questions? Comments? I'll make sure there's a place to post those answers on campus for you. So I know that you all are busy in other classes, so hopefully this spare time that we have in this class will help you out. As we cover the important stuff. The other topics that are there on the syllabus, you might find 2 or 3 multiple choice questions on the CPA exam now. So I will make sure in the bonus video, which will be that one, I hit the highlights of them. And the things that you would likely be tested on if they test you. For the CPA exam, it's always a balancing act. If I get too in-depth into material, well, information overload, you won't learn it. But if I don't get in-depth enough into material, then you won't learn what you need either. So I've got to strike it just right. That's always a challenge in this class. And you'll be very well prepared for the CPA exam. Once you take the second auditing course in the MAC program, hopefully you'll be in the MAC program. Hopefully you'll get your CPA. It's a major career goal. Opens up a lot of doors. So after that second auditing class, most of my students in there go ahead and take the auditing section of the CPA exam because they're well prepared. They usually do extremely well. Not to worry. I definitely keep up with what's being asked on the CPA exam and make sure that I address it accordingly. So other questions, comments, anything?
Are you feeling better?
I am, thanks. Recovering here. So it's taken a while, but yeah, a lot stronger, a whole lot stronger. So I can start telling the difference now, knock on wood. Yeah. So, yeah, nasty bone infection on intravenous antibiotics in the hospital. It was totally unexpected. And once an infection gets into the bone, it's hard to get rid of. I was talking to somebody today who had the same thing. And he said, oh, yeah. So you don't want one. But they're not quite sure how I got it. It's just like a couple of years ago, Bernard Davis had a similar infection in his knee. And they don't know how the infection got in there. It took him a very long time to heal up. So now I can definitely empathize. What else do you have for me? Any way I can help? Any questions, etc.?
Could you just give like a brief breakdown of the next few weeks then? Just so it's like all in one place.
Of the next few weeks.
Yeah.
Okay. So let me go ahead and share my screen with the syllabus here. So we've had exam 2, and we just concluded the other assurance services. Don't worry about this with my accounting lab. Okay. You don't have to do any homework. Then I'll have a video that has the meaning of Gaap, letters for underwriters, SEC filings, and review of interim financial information. The quality control standards, we've covered enough back in chapter 2. And then I had continuation of above, catch up, etc. So again, that bonus video is going to be about these 4 topics here. And there was nothing on my accounting lab anyway, no homework, no quiz on those things. So that might give you a couple of extra points on the CPA exam towards your 75. Did that clear up your question?
Yes, thank you.
All right, my pleasure.
So there will be no class next week, just the video you're going to send to us?
Just the video. So for next week, go ahead and catch up on everything with my accounting lab, etc. And catch up on other classes. I know a lot of you have Selena Josie's class. How's that going?
I think she's trying to kill us.
Uh-oh. Oh, it's definitely going to be catch-up time there for you.
She has us taking a quiz every week the next 3 weeks. I mean a test, not a quiz.
Oh, even worse than a quiz. Ugh. I don't envy you all. Goodness. So
Will we not have class on the 5th then either? We'll just be doing the exam?
that's correct, yeah. And Florida Southern does not designate the last day of class as an official class day, shall we say, where we have discussion and all that. It's designated solely to take the exam. And for some reason, they do that a week early with graduate classes and also with evening classes like ours. I think they did that back in the old days when they had limited rooms and they ran a lot of day class exams actually in the evening. That's the way it appears to be. But it's one of those institutional practices that just got ingrained and people don't ask why. There's Leona's kitty again.
Dr. William, I had a so I guess I'm just trying to understand this extra thing we have for chapter 25.
Okay.
It's going to be on my accounting lab. You just haven't put it up yet, you said, or?
Oh, for chapter 25, you won't have anything on my accounting lab. You don't
Okay.
have to do the homework, you don't have to do a quiz. For the additional video, I will post it on YouTube and send you the link.
Okay. So there's nothing for chapter 25 then?
Oh, for chapter 25, the only thing you'd be tested on would be the special reports we just covered. That
Okay.
is chapter 25.
Okay, but there's no actual homework assignment or quiz for it?
Correct.
Okay. Okay,
Good.
thank you.
You bet, Colleen. Yeah, Isabella. Yeah, so Selena Josie is a tough teacher. This is true. And the material's tough. Double whammy. What other questions? Comments? Anything?
Yeah, Professor, so you said we don't have class next week or the 5th, so is this our last class?
This is actually our last class.
Oh,
I know. I've really enjoyed this class. I wish I could have been there live for the whole schmear. This was the last thing I ever thought would happen to me. But thank goodness for remote, and we did just fine. And, you know, well, it would have been more fun in person, though. I totally admit that. I miss seeing everybody in person and the in-person interaction. We really did have a good class. Really good. So I'm grateful for that. I'll never forget it. I taught auditing a whole bunch of times too, as I say that. A whole bunch of years have gone past. Yeah, in fact, I've been teaching 35 years now. Phew. Maybe I'll make a career out of it someday. Yeah, so auditing's always a fun topic. I'm glad it's not computational. Gives us a break. What else do you have for me? Anything else? Well, I hope that I see all of you, maybe almost all of you, in the MAC program. So we'll have another good class. I'll be face-to-face and we'll have interaction and lots of fun. And actually, I'm sure that we're going to have some remote stuff. Okay. And we're starting up again. The Gaap will fix it. Sourcing computer parts is very difficult. All right. Anything else? Okay. Now, I guess that fan is applause for our class. So thank you so much for being a group. I really appreciate that.
Have a good night.
Thank you.
Thank you.
Thank you.
Thank you, Professor.
Thank you, Professor. Have a good night.
Thank
Appreciate
you.
that. Thanks so much.
thank you.
We miss you all. Thanks.
Thank you.
Thank you. Bye-bye.